welcome to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches and right around Australia on the Community Radio Network. We also go out on YouTube, iHeartRadio, Spotify, and a whole range of multimedia channels and fabulous ways to get a hold of us. So don't hesitate, reach out. We've got socials and a whole bunch of other things. We go out through the IFPA training network as well for CPD points. So we do a whole range of different things with this wonderful content that we create every week. Now, this week, we have somebody new, Nick Raphaely, who is the co-founder of AltX. Now, who is AltX? I'm going to not steal the thunder from Nick, but welcome to the show, Nick.
All right, great to be here. Thank you for having me on.
Wonderful. Now, first things first, Nick, let's hear a bit of a background. You know, where have you come from and why did you start AltX?
Sure. So it's I think, quite an interesting story, Ray. My background has been in financial services really for all of my working career, and I was involved in a funds management business sort of in the lead up to the GFC. And we had a very good run, kind of 05, 06, 07. And then when the GFC came in 2008, the business and the industry hit some pretty heavy headwinds. And what was a really good business became a much tougher business in terms of the space we were in at that time. And so we were facing these pretty heavy headwinds. And so it got us thinking, if we are facing headwinds, someone else must be catching tailwinds. And how could we identify what they were? And the light bulb moment for us came, somewhat fortuitously at a barbecue. All good Aussie businesses should have a story of a barbecue associated with them. And I like to say that our moment came at a barbecue, and here's what happened. My business partner, well, he wasn't then my business partner, he was a friend, Stephen and I. We were at a barbecue talking to a friend, John. John needed to borrow some money. So he was explaining to us what his requirements were. So he had an apartment in Ryde worth $1 million, an unencumbered unit, and he needed to borrow $400,000. So he needed $400 secured against an asset worth $1 million. There was no mortgage on the property at the time. He was and is a small business owner, and what he was doing, he was importing goods in time for Christmas. So he needed to get the cash to place the order to put the goods on the sea to bring them in time for Christmas. And as he was explaining it to us, we were thinking, well, this is obviously what the banks would do. You've got a loan of $400,000 secured against an asset worth $1 million. Registered first mortgage, guarantees from the borrower. He actually had a tenant in there, so there was income coming off the asset. And his plan was to sell the asset the following year once the lease had expired. So a nice, clean, elegant exit strategy without too much friction. So as I say, as he was explaining it, we were thinking, well, the bank will swallow this up because it's what banks do. That
should be a no-brainer.
They make all this money, lending money where it's impossible to lose. And then John started to explain the reality. He had a good relationship with the bank, but his tax returns weren't up to date because he'd been too busy with his business. His income was quite lumpy because that was the nature of it as being a business owner where it's not consistent income every month. He technically didn't fit any of their products. They have this whole suite of products, and they couldn't quite box him into to match his requirements to what the bank was offering. He wanted a short-term loan. They were more geared to all these sorts of things. So we're sort of listening to all these objections. And the most important thing, Ray, was he said, I need the money in 10 days' time, because if I miss it in time, it's all for naught. And so speed and flexibility and a bit of creativity and the ability just to be a bit commercial and understand what I'm trying to do actually trumps everything. So Stephen and I were listening to this, and we were thinking, well, we haven't been lenders per se or been in credit per se, but this just feels like good business. There's a guy we know, he's guaranteeing the loan, it's secured by an asset, there's a story behind it, there's a business, there's an exit strategy, there's income off the assets. This just felt like a smart thing to do. And that really was the moment that we sort of started to find our way into the private real estate credit space. Important to note, Ray, back then, the space was unknown, the concept was unknown. And so, all the questions we asked ourselves about, why is John not going to the bank? When we started to kind of raise money for the business and we found deals 2, 3, and 4, the people that we went to, our network, our friends and family, they were as skeptical as we were. They were like, Nick, it seems like it makes sense. We trust you. You're putting your own money into it, but there must be some hairs on the transaction that you're not explaining to us, because otherwise the bank would be writing the business. It took quite a while, Ray, for the market to understand that while banks are really good at doing what they do, there is a particular demand for credit delivered up to borrowers in a certain way, which non-bank providers of money are better equipped to do than banks. Just as a
and what year was that, Nick?
So we started in 2012, and I might just expand a bit more because it actually paints to the tail. As I mentioned, we were looking for the tailwind, so it wasn't completely by accident that we sort of found this, because you've got to be looking in order to find. However, I have to acknowledge we hit the market at a perfect time, and you need a bit of luck when you start a business. So if you cast your mind back, after the GFC, rates in the US fell almost immediately. Australia held their rates higher for the first few years and really only started to drop rates in 2012. So pretty much as we opened our doors, rates started to come down year on year on year for about 7 or 8 years. Ray, that meant two things for our business. The first thing was we were lending secured against assets, and we were sort of learning on the run. Obviously, we were being as diligent as we could, but naturally you're making mistakes when you kind of, you're setting out and doing something new. So we might have been using the wrong valuers, or not properly understanding the nature of the security, maybe extending the LVRs too much. But we were very fortunate because as rates were coming down, assets were going up because they inversely correlated. So if we lent against an asset for $1 million or valued at $1 million, the next year it was worth 1.1 or 1.2. So if we slightly extended ourselves, the market was forgiving us through assets going up as rates came down. That was the one side. The other side, equally as important, Ray, was as rates came down, investors couldn't get any yield. And it's hard to think about it now, but a decade or so ago, the catch cry of the hunt for yield, starve for yield, where is the yield? Term deposits at 0.1%, no one could get any yield. So there was a cohort of investors that had been burnt during the GFC, investing in weird and wonderful things that they didn't fully understand. And now we came along, we and others, in this private real estate credit space with a really, really simple proposition. There's a first mortgage loan with a registered mortgage to a borrower with guarantees, secured by an asset with a valuation report that you can drive past and look at. You can call your friend, the estate agent, to check it. Your brother-in-law, the lawyer, can check the loan docs. It was a very, very simple and easy to understand proposition. And I think, Ray, that really resonated with the investor community. So we were fortunate in that our collateral was going up, but also that as rates stayed low, what we were offering to investors, yields of, I forget exactly what they were, but they were probably between 7 and 9% at the time, were very, very attractive in an environment where there was no good quality yield, or yield was very, very hard to come by at the time.
Yeah, I got to say that's interesting timing, because I actually found out about private credit at my army reunion, of all things.
Yes.
Back in 2001. And I started investing in private credit with my wife in 2002. And so by the time the GFC came along, we'd been investing by that stage 7 or 8 years in a friend's company that I knew from my army days. And the interest rates, as you rightly say, even if you got it wrong, the asset values were climbing so much that one year the LVR was 60% or 70%, or even if you extended yourself a little bit more. But the following year, because the asset value went up so much, that LVR actually went down and made the loan safer. And so it was a concept that I found out about very early on. And like you're explaining it to people and they're going, oh, there's got to be a trick. There's got to be a catch to it. And I'm going, there actually isn't. It's the lending model is no different to a bank with a high street loan with a consumer code today that, if you don't pay it back, guys, guess what? They take your house back. Again, that's the ugly side of the business that we're in, I guess, Nick, is that, that can happen. It's
interesting that, Ray, because when we present to investors, we actually have one of the slides in one of our decks, and it lines up. There's a column AltX and there's a column the bank. And we have a thing, valuation report. The bank requires one, tick. We require one, tick. Then, signed loan documents from the borrower, tick, tick.
Tick, tick, tick.
Tick, tick, personal guarantee to pay back the loan if the asset doesn't cover what's due to the lender, tick, tick. Interest paid monthly, tick, tick. The only real difference is that obviously the bank provides the money versus the private investors provide the money. And then the term of the loan. The bank will sign you up for 30 years, whereas our loans, and we've got a range of products in AltX now, but the one that we talk to investors about is a up to 36 months. So it's a shorter duration, which suits what investors are.
But I think you mentioned a good one too, where your friend was trying to organise this finance in 10 days. And I know in my early days, I was watching loans turn around in 3 to 5 business days. And that really, sang to the marketplace that my mate was servicing at the time, and we were investing in these loans through him. And again, even today, one of the highlights of private credit is that if you need money quickly, the private credit market can react. Now, I know that the advertising says 3 to 5 days. That's if you've got your documentation in order. A lot of people don't, so sometimes it takes a bit longer. I guess one of the things, the next question I've got for you though is, certainly in the education material I provide through OTG Capital, I try and say to people, look, a bond is no different to a loan, and that's what you're doing at AltX. You're lending money. But why is this different to, say, a commercial bond that you might buy on the bonds market?
Well, I think in what we do, it's obviously secured by real estate. So our particular model, and people run different models, right? Our model is we do loans secured by particular assets, and we actually ring fence every transaction in an SPV, a special purpose vehicle. So, for example, if you came to AltX and you invested in a deal secured by an asset in Bondi, for example, you set up a separate company. The company holds the mortgage. The investors take notes in the company. I say company, it's an entity set up solely for the purpose. You know that your risk is ring fenced purely to that asset and the ability of that particular borrower to repay you. So whatever else may be going on in our business at the time, as long as you're comfortable with the risk that you're taking, your risk is ring fenced and isolated to, as I said, the asset and the borrower. It's real estate focused and it's ring fenced. I would say those are the main things. Obviously, when you're buying a bond, if it's a corporate bond, you're taking counterparty risk from the company that's borrowing the money, and I guess you're taking the operating risk of the business on an ongoing basis to be able to meet its obligations and pay its debt, and then in all likelihood probably to roll the debt at the end of the term, because they typically wouldn't pay it back. This is very different. I think investors like this model, Ray, because they know the asset that is securing their loan. It's very, very simple and straightforward. I might just expand on just a little bit. When we started the business, we kind of figured we wanted to do a good thing pretty early on. The hard part was, how do we actually get in front of people? So, pretty quickly when you're growing, you exhaust your immediate network, and now you need to find more investors. And we would sit here in Bondi Junction, which is where our office is in Sydney, and we'd look across the water. We'd say, there's an orthodontist in Mossman who's got a big super fund. And, although he doesn't have a financial background, he could understand exactly what we do, because it's really a loan secured by a mortgage. The problem is, how do you actually get in front of him and show him the deal? He spends his day in the surgery and he's running his practice and so forth. So what we ended up doing as AltX from a distribution perspective was we built a technology platform which enables us to showcase deals to prospective investors that can invest in the deal. They onboard in the first instance, so we do all the KYC, the compliance and the onboarding. Then they invest through the platform. They can seal their deals. They can set up multiple entities. At the end of the year, they can download tax statements, for their accountant, etc. It's really a portal where they can run their whole portfolio through AltX. And that was just about, how do you actually take this great story, not the AltX story, but the private credit story, to the dentist in Darwin, the farmer in Wagga, the tradie in Perth, etc., etc.
And simplify it. And you did that with a good technology platform. So look, we're just about half time. You're here on Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I'm here today with Nick Raphaely from AltX. We're going to take a short break and be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone this week a new guest, Nick Raphaely, who is the co-founder and executive at AltX, a private credit provider. And today we're talking about why private credit is hot. Now, before we went to the break, Nick, we were talking about how you started AltX, and I guess aspects of what makes a real estate backed loan different to a commercial bond. And I think the key message that you left with before we went to the break is that when you invest in a commercial bond, let's say you took a bond out with BHP, you are relying purely on the reputation of BHP in the marketplace. And people have a very good view, I guess, of BHP. They're a multi-billion-dollar organization, whereas the loans that we do in private credit, we are relying on the value of a piece of real estate that will be there if the borrower doesn't pay back. And I think they're good distinctions. So let's move on a little bit. There are many private credit providers out there now. And given that I've been involved in this game now for, well over 20 odd years, 10, 12 years ago, yourself, Nick, there weren't that many private credit providers out there. Now the market is awash. Why has all of a sudden private credit become hot?
It's a very interesting question, Ray, and I think the answer that I would offer is theoretically the barriers to entry are low. And I'll explain what I mean by theoretically. So if you think about what the business is, you need to source loan transactions, typically from brokers, and you need to have some money to be able to lend out, either your own means or assembled through a network, whatever it may be. And then you need a set of loan documents, obviously, to tie the two together, to commit the borrower and ensure the payments go through to the investor or the provider of capital. And then some sort of rudimentary system to be able to manage it all, collect the interest,
do the books.
And exactly. So if you think about that compared to starting building a factory or like an industrial business, the barriers to entry are really, really, really low. So I say somewhat flippantly when I talk to people, if you've got a small checkbook, a bit of ambition, and a network, you could be competing with AltX, which employs 80 odd people and has been going for over a decade. And I say it somewhat flippantly, but also sincerely, because you could be competing. However, when you start to unpack it a bit, what seems like an easy business is actually not such a straightforward business, as all businesses are. I'll just give you a couple of examples. So you could be sitting at home competing with AltX, and a broker emails a deal through to you. And you say, oh, that's really good. I'm getting deal flow. I'm feeling good about myself. The question I encourage people to ask themselves is, do you think you're the first or the last person to see this deal? So take our business and others like us. We've got 10 odd BDMs based all across the country that are building relationships with brokers, promoting what we do all day, every day. So you would have to think logically that AltX and similar businesses see the deal first. So if you're sitting at home in your study and the deal hits your desk, do you think you're getting the pick of the pick, or you think you're getting the scraps that everybody else hasn't taken? Now, the truth is you wouldn't know, because you're really not in the network. You're just starting out, and you think, I'm getting deal flow, but you could be getting, what we sometimes call the stinky fish, the deal that just sort of floats around that nobody wants to touch. So you've got to be careful of that. This is one example. Another is valuation reports, and we learned this the hard way, right? When we started our business, we thought that all values were created equal, and if you had a valuation report to support a transaction, you could tick it off, and whatever the value said was rock solid. That's what the asset is worth. That's what it will sell for. You can rely on that number to support your transaction. I think what we learned over time is that different values have markedly different approaches to how they actually value securities. And within our business, we have a panel, and the panel is very nuanced. It varies by state, it varies by transaction size, it varies by asset class. And we've kind of curated it and evolved it over time to make sure that it makes sense for what we're doing. So if we're trying to value a commercial asset in far north Queensland, we'd be using a very particular value we would use for that versus a resi house on the northern beaches, for example.
Sure.
Now, if you're just starting out and a broker says, here's the transaction, and I've saved you the work, I've already got a valuation report, you might be thinking, wow, this is really easy. I don't even need to do that piece of work. What can often happen is that the borrower and broker get into the ear of the valuer and talk the value of the asset up. So we have a practice at AltX that we we always insist on commissioning the valuation report ourselves, just to make sure that we have the direct communication with the valuer.
Gotcha.
There's no noise or interference from any other parties. So to the question of why is the space populated, I think on the face of it, the barriers to entry are low. But I think once you get into it, and the other thing, Ray, is when you do a loan today, you only get your homework back in 12 months' time, because you can do a loan and capitalize the interest. So you might think all's good. In 12 months' time, the borrower may have disappeared. The asset value may be, not what the valuation report suggests it would have been. Your problem only arises then. So people who start in the business today, they might think they're going swimmingly, but only down the track do they actually realize what's going on. So I think that on the face of it, it's easy and it's attractive and fairly straightforward and so forth, but there's a lot of nuances to be considered.
No, very, very good points. Very good points to make. Now, I notice AltX, like OTG Capital, you're a wholesale provider. I wanted to ask you a question a little bit left field. AFCA have recently bought into the debate around retail and wholesale investors. Now, for our listeners out there, the market very crudely is delineated between retail and wholesale. Retail, as the name obviously implies, is for anybody and everybody. But wholesale, the actual definition, ladies and gentlemen, for wholesale was coined back in 2001 and legislated. That hasn't changed. And so the 2.5 million of assets, the $250,000 yearly income for a couple of years, or a minimum $500,000 investment that was set in 2001 still applies today. Now, AFCA, the Australian Financial Complaints Authority, have stepped in and said, when dealing with SMSFs, we are now going to set a $10 million trust level, which was always again in legislation, but never really adhered to. And so we've now got a bit of a contrary message out there that, particularly with a lot of self-managed superannuants out there, they're being asked to potentially have a lot more assets than if they were just a straight out investor. Nick, I'd like your view on that. With AFCA now buying in, what's your view of this wholesale retail test?
I think you make an interesting point. The fact that I think you said 2001 or 2002, the thresholds were set and they haven't moved. If you would have indexed the income test and the assets test by CPI, 2 to 3% a year for 20 odd years, the numbers would be, the thresholds would be materially different. I mean, a $2.5 million net assets, say the value of your house. Not a lot of people would have had that back in 2001. Today, with asset inflation, a lot of people who are not particularly sophisticated will be able to lay claim to that. Equally, incomes back in 2001, 250 grand was a big income. Today, it's still a substantial income, but not to the same extent that it was. So I think there's probably some room to go there, Ray, in terms of moving those thresholds. I think that probably the more maybe relevant and overarching point I would make is, as a provider of the product, you want to make sure that the people that invest with you actually understand what you do.
Good point.
And are the right people for you. And I'll just play that out just a little bit if I can. So we sometimes have investors that come to us and they say, Nick, I've heard about you guys. My next door neighbor invests with you. I've seen your material. It all stacks up quite nicely. But so-and-so down the road, they do the same thing as you, Nick, and they pay 3% more. So I'm kind of a bit torn. What are your thoughts on that? Typically, we've often heard of the competitors that they mention. We know who our competitors are. We don't know intricately what they do. And so we're not really in a position to give deep comments on what they do. But generally, we say, yeah, we've heard of those guys. They seem to run a good shop. But then we pivot the conversation, right? And we say, we don't know what others do, but we know what we do. And we know why we do it and how we do it. So as I mentioned earlier, the separate SPV, the team, the credit team, the track record, the process, the AltX platform to manage the investments. We have an open door policy. We've written as a business over $6 billion worth of transactions. So we've been going a while. And what I say, and then I explain the risks. This is what we do. These things can go wrong. You'd be unlikely to lose money, but you certainly can lose money. This is how you could lose money. And at the end of it, I say, if all of that resonates with you as a potential investor, and you think this is a place where you want to park some money or to invest, we'd love to have you. If you understand what we do, if you're comfortable with what we do, and you're not going to be eaten up by the fact that someone else down the road pays 2% or 3% more than what AltX pays, then come with us. If you feel that the other person is more suitable for you, you need to go there. If you want to split it 50-50, if you want to think about it and come back in a week, whatever you want to do. We found out over time that our best investors are the ones that really understand what we do. So when things go wrong, because things do go wrong, it's not a surprise. You know, a deal may run over, borrower may not pay, you may have to repossess a property and sell it. You know, not all the interest may come back. All manner of things can happen. I think the most important thing is to have investors that understand what you do, be that wholesale or retail.
I think you've made an excellent point. And one of the things that I might highlight to ladies and gentlemen listeners out there is that the Financial Complaints Authority will listen to wholesale investors, okay? And I think they've put a shot across the bow of the industry, particularly around SMSFs, because there are a lot of people out there in our neck of the woods as fund managers that were accepting all trustees regardless of their asset base. And that was dangerous. And I've heard many of our competitors out there that say, oh, if you're a trustee, we accept you as sophisticated. That's a bad thing to do because, Nick, you've seen it as well. Just because you've got a very expensive house doesn't mean you're sophisticated and you understand the investing game. I think you've made a great point there. I think AFCA is simply saying you've got an avenue, even if you're a wholesale investor, for redress if you think you've been wronged. And we do the same thing. We try and let people know, please be sure about what you're doing before you come on board with us. Now, I think, you know, we're just about to wrap up. I think you made a good point. There's no such thing as a sure thing. And we try and educate our investors along the way. And that's what the whole point of Dollars and Making Sense is, I guess. I always like to leave our listeners with a nice, really good takeaway. If I can ask you, Nick, what's one really clear takeaway that you should leave with the listeners?
I would say two things. You asked for one, but I'm going to offer two, if I may. The first is, and it ties to what I was saying just a bit earlier, is really trying to understand what you're investing in, because if you know what you're investing in, then you'll be more comfortable and your relationship with your fund manager will be better. And surprises, if and when they come, won't be surprises because they generally are foreseeable things. And the best investors are the ones that actually, they're in sync. And so if you have to communicate an issue, it's not hold on, how could that have happened? You know.
And number two?
Your salesperson know. And number two, diversify, right? I would say diversify because you never know where lightning strikes.
Good advice. Good advice. We're just about out of time. Nick Raphaely, absolute pleasure having you on the show. This time goes so darn fast. I'd love to have you back, and there's always topics in private credit to talk about. It's been a real pleasure having you on the show for the first time. Hopefully you'll be back again in the near future.
Thank you, Ray. Really enjoyed it. Appreciate it. Thank you.
Cheers. Have a great day.
Bye-bye.